Hello, everyone, and welcome back to the Deep Dive. Hope you're having a fantastic week and are ready for another, well, deep dive.
Absolutely. Ready to get into it.
Today, we're breaking down one of the real titans of modern cybersecurity, Palo Alto networks. You'll see it's PANW. It started, quite focused, but now it's just this massive player defining the space.
It really is. And the core question for you as a long-term investor thinking potentially decades out is this. Is PANW truly one of those wonderful companies? Have they built a durable fortress? Or is there maybe some weakness hiding behind that impressive growth story?
That's exactly what we're here to find out. And before we jump into the analysis, just a quick note for everyone watching or listening.
Yeah, go ahead.
For those who want to act on these investing ideas, having a professional-grade platform is, well, it's key. We use Interactive Brokers, and we've actually partnered with them to get our viewers a stock bonus when they sign up using our link.
So they get a bonus and support the channel. Win-win. That link is in the description, right?
That's right, down below. And, of course, if you find value in this kind of, in-depth discussion, the best way to let us know and to make sure you get the next one is to subscribe and like the video. It genuinely helps the channel grow.
And definitely drop your questions about PANW in the comments. We do read them.
Absolutely. Okay, let's get into it. So PANW, we need to understand how they evolved. They started selling hardware, right? The firewall, kind of the razor.
Exactly. The next generation firewall, or NGFW, that was the initial wedge. But the genius was shifting to selling high-margin, recurring software and services on top of that hardware. Those are the blades.
And they've organized this into three main pillars now.
Correct. First is Strata. That's the original network security stuff. Think the evolution of that NGFW, plus the newer cloud-integrated network security, what they call SASM.
SASM being Secure Access Service Edge. Yeah. Basically pushing security out closer to the user, wherever they are, integrating it into the network fabric itself.
Precisely. Makes security more seamless, less of a bottleneck. Then Pillar 2 is Prisma. This is all about cloud security, largely built through a string of acquisitions, aiming to secure cloud-native applications, data infrastructure, the whole cloud environment.
And the third?
That's Cortex. This one focuses on security operations, or SOC. They're pushing hard here with AI-driven platforms like XSIAM, trying to automate and replace older, more manual security monitoring tools like SIEMs.
Okay, so platform company. Let's unpack the business model. It seems like there's this fundamental tailwind here, this Red Queen effect you mentioned.
Yes, this is absolutely central to understanding why cybersecurity spending is so resilient. Remember the Red Queen in Alice in Wonderland? She says, it takes all the running you can do to keep in the same place.
Right.
That's exactly the situation for corporate security teams, the CISOs, the threat actors, the hackers, the state-sponsored groups. They are constantly innovating. They're using AI now, launching more sophisticated attacks faster.
So companies have to keep spending, keep upgrading, just to maintain their current defense level, running just to stand still against the threats.
And that makes the spending essentially non-discretionary. You can't just decide to skip security upgrades for a year because the budget's tight, the threats won't wait. And this actually elevates the whole conversation inside companies.
How so?
Well, security isn't just some IT cost center buried in the budget anymore. It's a board-level strategic imperative. It's seen as a revenue enabler. You can't run a modern digital business safely without robust security.
Okay, so the demand is structural, almost guaranteed to grow. The tech is complex, tons of acronyms, but the business model is actually pretty simple at its core, isn't it?
Very simple. They sell protection, resilience, operational efficiency, and they do it mostly through sticky subscriptions and support contracts. That recurring revenue is the goldmine.
Which means customer retention is everything. So what have they built to lock customers in? What's the competitive moat?
In one phrase, high switching costs. But it's not just one thing. It's layered, interlocking, making it incredibly painful to leave.
Let's break that down. Layer 1 is technical, the open heart surgery risk, you called it.
Yeah, think about where PANW sits. Their firewalls see all the network traffic. Cortex ingests data from everywhere. It's deeply embedded in the central nervous system of a company's IT.
So ripping it out isn't like swapping out a printer.
Not even close. It's a massive, high-risk, potentially destabilizing project. You lose years of configuration, historical data, threat intelligence that's specific to your environment stored in their system. It's crippling.
Okay, that's the tech layer. But you argue the human capital cost is maybe even stickier.
Absolutely. This is where the golden handcuffs really lock tight.
Yeah.
Think about the security teams. They spend years getting trained, certified, and just becoming experts on PANW's proprietary operating system, PANOS.
Right, they build up all that muscle memory, the institutional knowledge.
Exactly. So if a CISO decides, okay, we're switching to competitor X, they're not just buying new boxes. They are forcing their entire global security team into potentially years of expensive retraining. People hate change, especially when they feel expert in the current system. The cost, the disruption, the risk of errors during transition, it's enormous.
It's the organizational inertia. That makes sense. Now, this leads to what you call the platform Lollapalooza effect. The idea that combining advantages creates something more powerful than the sum of its parts.
Correct. It's a nonlinear effect. Charlie Munger talks about this. The first big factor here is a powerful data network effect.
How does that work in cybersecurity?
Well, the PANW platform is constantly learning. It monitors and actively blocks something like 30 billion potential attacks every single day across its customer base. That's an immense real-time feed of threat intelligence.
And that data feeds their AI engines.
Precisely. So more customers means more data flowing in. More data means smarter AI, better threat detection, faster responses. Better protection attracts more customers.
So it becomes this self-reinforcing cycle. Very hard for smaller point solutions to compete with that data advantage.
Extremely hard. The second Lollapalooza factor is more intangible, but just as important. Brand and reputation.
The old nobody gets fired for buying IBM effect, but for cybersecurity.
Exactly that. PANW is consistently ranked as a leader by Gartner, Forrester, all the third-party analysts. For a CISO, choosing PANW is the safe, validated choice. It reduces career risk. That lowers friction in the sales process significantly.
And you mentioned there's hard data showing consolidation onto PANW actually pays off for customers. The ultimate lock-in.
Yes, this is the clincher. There are studies, real-world examples, showing organizations that were juggling, say, 15 or 20 different security tools consolidated onto the PANW platform.
And the results.
Pretty staggering.
Yep.
One composite analysis showed a 174% return on investment and over $26 million in net present value over just 3 years. Basically, the cost savings and risk reduction from consolidating paid the customer to adopt the platform more deeply.
Wow. So the platform literally pays you to increase your switching cost. That's powerful. Okay, formidable moat. Let's shift to management and potential risks. CEO Nikesh Arora is known for this platform or die mantra.
Right. His core strategy seems to be what we can call auto-catalysis. He has this incredible asset, the existing base of over 80,000 customers, like the Disney Vault of enterprise clients.
And the idea is to just keep selling them more stuff.
Pretty much. But strategically, cross-sell the newer platforms Prisma for cloud, Cortex for SOC into that massive installed base. The incremental cost to acquire that next sale from an existing customer is near zero compared to winning a brand new logo. They already have the relationship, the master service agreement, the technical footprint.
Makes sense. And the biggest test of this auto-catalysis strategy right now is the massive $25 billion deal to acquire CyberArk.
Oh, absolutely. This is the make or break test in many ways. CyberArk is the undisputed leader in identity security, which is a super critical adjacent market.
So the bull case is clear. Buy the leader, plug it into your 80,000 plus customer distribution channel, and boom, another multi-billion-dollar pillar.
That's the dream scenario. Instant market leadership in a key category, massive cross-sell opportunity. It looks brilliant on paper.
But let's invert, as Munger would say. What's the bear case? The huge risk here.
The risk is one word: diversification. They're not buying some nimble little startup they can easily integrate. CyberArk is a large, successful public company with its own history, its own tech stack, its own, frankly, integration debt.
So the danger is?
The danger is they can't actually integrate it smoothly, that they end up with this clunky, bolted-together platform of platforms that doesn't deliver the seamless experience customers expect. It could collapse under its own complexity, alienate customers, and just be a massive execution failure. The integration risk is immense.
And this complexity, this potential integration debt, seems to be showing up already in a really critical area, undermining that brand moat we talked about. Let's talk about the Scuttlebutt warning.
Yeah, this was, frankly, quite alarming when we dug into it. It's the single biggest operational red flag we found. There's this dangerous duality.
Duality, how?
High-level execs, the CISOs, the people reading Gartner reports, they love the platform vision. PANW gets great reviews there, 4.5, 4.6 stars. But when you go to the online forums, the places where the actual network engineers, the people using the product day in, day out, hang out, The sentiment towards PANW's customer support is shockingly negative. Passionately so.
We saw some brutal quotes, things like, terrible support staff are just script readers. And the most damaging one, comparing the experience to dealing with their cable company, exactly the same as Xfinity.
Ouch. That Xfinity comparison is just poison for a premium enterprise-grade security vendor. It implies frustrating, bureaucratic, ineffective support. And this isn't just griping, it's a real problem.
Why is it such a strategic threat?
Because it's a self-inflicted wound. It directly hits their brand reputation for quality and reliability. And more importantly, it gives those frustrated engineers, the ones who actually use the gear, a powerful reason to lobby their bosses to look elsewhere. Maybe towards a competitor like Fortinet, who might be seen as good enough and maybe, just maybe, easier to deal with support-wise. That support issue is the canary in the coal mine for integration problems, I think.
It really feels like the Achilles heel. If the strategy is sound, but the execution, the customer experience, is failing at the ground level, that's a serious challenge to the wonderful company idea.
Okay, but let's look at the financials. Because despite that operational worry, the financial picture looks incredibly strong.
It does. They hit a really important financial inflection point recently. For years, they ran GAAP losses, investing heavily in growth, R&D, all those acquisitions. But now they're showing consistent, scalable GAAP profitability. That signals a maturing, powerful business model.
And the key proof point for the platform strategy paying off financially is return on invested capital, ROIC. Absolutely. ROIC is the acid test. Is the money they're plowing back into the business actually generating good returns? And for PANW, the answer is a resounding yes recently. They went from a negative ROIC minus almost 5% just a few years back in FY21 to a very healthy positive 13.44% in FY24.
That's a huge swing.
Huge. It shows that the billions spent on building out Prisma and Cortex and integrating everything are starting to generate really strong returns on capital. The platform strategy is working, financially speaking.
And boy, does it generate cash.
Oh, yeah. It's a cash flow machine. They're guiding for an adjusted free cash flow margin between 37.5% and 38.0%. That is absolutely elite territory for any software company. Top tier.
And that massive free cash flow is what fuels the whole engine, right? Funds the R&D, pays for deals like CyberArk.
Exactly. It's the lifeblood that allows them to keep investing aggressively in maintaining that platform leadership.
Okay, so fantastic financial profile, strong moat, which inevitably leads us to valuation. This kind of quality doesn't come cheap, does it?
Almost never. PANW consistently trades at a premium valuation, usually somewhere in the 30x to 38x price to free cash flow range. That's at the high end of its historical band.
So the margin of safety isn't really found in the price tag itself.
No, it's qualitative. You're paying up because you believe in the durability of that moat, the quality of the earnings, the resilience of that free cash flow stream. You're unlikely to ever find PANW in the bargain bin unless something goes significantly wrong or the market temporarily panics.
So as an investor, you're essentially waiting for one of those temporary company-specific issues. Maybe those CyberArk integration struggles create some noise, or they miss a quarterly guidance number. That's the potential entry point.
That's likely the scenario. You have to be prepared to pay a fair, maybe even slightly high price based on historical metrics, but you're hoping to get it during a moment of temporary fear or uncertainty that might push it towards the lower end of that premium range.
And looking ahead, what's the single most critical metric investors should be watching to gauge if that auto-catalysis strategy is firing on all cylinders?
It's next-generation security annual recurring revenue, or NGS ARR. That number captures the growth from the newer platform modules, Prisma, Cortex, ASIC, the things they're cross-selling, into that big customer base. If NGS ARR is growing strongly, it tells you the platform strategy, the Auto-Catalysis, is working. That's the engine of future profitable growth.
Okay, great. Let's wrap up with some second-level thinking. Applying Charlie Munger's invert, always invert. The simple first-level take seems to be, PANW is a great company, maybe best in class, but it looks expensive, and that CyberArk deal adds significant risk.
Right, that's the consensus view. The second level, perhaps contrarian perspective, might be that the market is too focused on the short-term noise, maybe a slight growth deceleration as they digest CyberArk, the integration hiccups. And in doing so, it's missing the bigger picture, the nonlinear power of that Lollapalooza effect. Right. Meaning PANW is effectively building the default operating system for enterprise security. The switching costs are becoming so immense that they're positioned to capture an ever larger share of the security wallet for many, many years. The current valuation might actually be reasonable if you truly believe in that multi-decade dominance.
But we have to run the red team challenge on that. We have to ask the tough question. Are we really looking at a seamlessly integrated fortress? Or is it possible this is more like a conglomerate of 20 different acquired companies held together primarily by marketing and sales muscle?
And that is the absolute core risk. The potential failure point isn't necessarily a competitor out-innovating them tomorrow. It's internal. It's if that integration complexity, the very thing causing that terrible Xfinity-like customer support experience, fundamentally overwhelms the value proposition.
If the seams start showing too much.
Exactly. If customers, particularly the engineers on the ground, feel the platform is becoming too clunky, too hard to manage, too frustrating to get support for, that's when the moat starts to erode from within.
Which brings us to our final provocative thought for you, the listener, to ponder. What's the right price? What's the real value of a potentially multi-decade compounder, a fortress like this, if its biggest near-term threat isn't external competition, but an internal, operational failure? Specifically, a breakdown in culture and customer service delivery, likely stemming from that integration debt. Is that kind of flaw something that seems, in theory, solvable, worth looking past for the long-term potential?
A tough question with no easy answer. Something to definitely think about. Until the next deep dive, keep digging, keep questioning, and keep thinking critically.